Good morning. We're breaking down how stock splits reshape your options from strike adjustments, share adjustments, deliverables, and option premiums. Let's take a look behind the curtain on the Trader's Workshop after the bell. You know, Cowboy Lex. That's what I'm saying. What's up, kid? How are you? No Mark again today. That guy's
right. Yeah. It's kind of sad that Mark's not here. This is definitely a Mark type of topic.
Oh yeah. I talked to him late yesterday. He's getting ready to go to Phoenix for some conference, I think, and he was bummed he's missing this. He wants to do it again on maybe takeovers and some weird things that happen in two-part deals and that sort of thing. So we'll hold that for the next conversation with Mark. But you and I are going to tackle stock splits, right? We just had one, incidentally. So I had a position in Netflix, didn't even know it was going to split. That's me paying attention again, not. Split 10 for 1. So that's an easy one. Let's go over just the basic ones, like 2 for 1s, 10 for 1s. Those are pretty simple, right? The one we're going to focus on after we explain these is the 3 for 2 stock split. That's a little trickier. Okay, so 10 for 1. You know what happens? Can you explain it for the folks?
Yeah, 10 for 1 stock split means that for every share that you own of the underlying, you are going to now receive 10 shares, but at a tenth of the price.
Okay, so point of there is that's very simple, right? You're going to get 10 times as much, but it's going to be a tenth of the price. The economic value that you will receive will be exactly the same. Correct. So there's no arb there whatsoever. So you will get the same, amount of value. Now, having said that, if you have options, right, what happens to option premiums? Well, you would think it's probably the same deal. If you sell a credit spread for $15 in the pre-split and it splits 10 for 1, it's going to be marked at $150, right? A tenth of $15. So pretty simple. And that's what happened to me. It wasn't exactly 15, but the math's easier. It was like $12.90, and my new price on my cost basis was 1.29 cents, right? So not too many tricks. No, something to keep in mind. That is on an even implied volatility. Now, it doesn't mean implied volatility doesn't shift one way or the other after the split. It could, it couldn't. You never know, right?
Yeah, Lex, you also forgot your strike changes.
Yep.
Your deliverable changes.
Yeah. Well, the deliverable the strike will be adjusted with a new OCC will give it a new suffix. It'll be Netflix 1 or whatever, Netflix 2. It depends on how they adjust that. Now, that deliverable though is still 100 shares, right? Because you got 10 times as many. Yeah. So that's not tricky. Now, those new suffix strikes, when they expire, cease to exist, right? And the OCC will list new strikes at the new level. So if you don't have strikes in between, they may list new strikes that don't have the suffix. They're the new listed strikes post-split. Does all that make sense?
Yeah. I mean, it makes sense to me, but
Yeah. If you have a question, fire it up in the chat so we can see it. Okay, good. Now, 2 for 1, same deal. Super easy. Your deliverable stays 100 shares, right? Just like all options. Do we go to 3 for 2 now? You ready for that? Is it time?
I don't know, Lex. I can handle 2 for 1s, but 3 for 2s, I don't know.
All right, let's do 3 for 2s. But we're going to go to the slide deck for this. So
slide deck, not the remarkable.
Not the remarkable. I decided to not do chicken scratch. So let's take a look at the slide deck here. All right, and again, to all you techies on Apple's computers, I apologize. I can't get this to run on my Apple computer and work, so I have to do it like this. So I apologize. All right, stock splits, options, and strikes in a 3 for 2 split, right? So this means what? That for every 2 you have, you're going to get 3. Or let's go down to basic math. For every 1 you have, you're going to get 1.5. Right? So this becomes interesting. Now, the deliverable changes here. So in your new split adjusted strikes that are the old symbol, okay, you are going to get 150 shares for those in the split. So the old strikes with the suffix, it's going to be a XYZ1 or 2. Those will expire into 150 shares, right? And that's the 1 to 1.5 version. I just divided 3 by 2 to get a base common denominator 1 by 1.5. Okay.
Mm-hmm.
With me so far? Okay,
Yep.
so those expire that way into 150 shares. Now, strike prices are multiplied by 2/3. Okay, we're going to show an example in a second. So the contracts still remain, it's one contract. You still can buy and sell ones. You're not buying halves or anything like that. You're still doing that. Deliverables 150. Strike price is going to be at 2/3. So let's see what happens here. Okay, let's take an example. So before the split, we're looking at one call contract. Strike price is 60. That represents 100 shares. Okay.
Mm-hmm.
After the 3-for-2 split, still one call contract, but the new strike. And here's the math. The old one was a 60, and you multiply it by 2/3, which comes out to be a 40 strike. Okay, so that's the new strike on that 60. But that deliverable on that 40 strike, which will be XYZ, 1, the 40 strike is 150 shares. Questions, comments, anything to say about all this so far?
Well, the first question I would have is the new shares, the one with the 150 share deliverables, etc.
Mm-hmm.
Can you buy those, or can you open a contract with those?
You can trade them. The 100, if you were signed and you had the 150 shares, you can absolutely trade them. They trade regular way.
Okay.
Yes. The answer is yes. Okay. So those trade regular way. There's going to be an interesting little twist at the end. I want your opinion on this from a mathematical standpoint. Okay. I'm going to show you at the end. This is a little trick, and some genius figured it out on the trading floor a long time ago. And I want to see what you think about it. All right. So this looks good. If you guys have questions, let me know. All right. What about strikes and premiums not divisible evenly by 2/3? What I mean by that is, you get a decimal point. It doesn't divide into 0.00000. Okay. So the OCC will round that strike to the nearest cent, okay, and create an adjusted options class. And again, it's usually a special symbol like XYZ1 or 2, or depends on what they'll do. Okay. Fractional or rounded strikes. Okay. Again, they represent 150 shares in a 3-for-2 split. They'll trade separately and under an adjusted ticker for the standard options listed post-split, with the standard options listed post-split. Okay. Now, let's take an example of this. Suppose you have a stock has a 47.5 strike before a 3-for-2 split. Okay. Mm-hmm. So you do the same math. Adjusted strike is 47.5 times 2/3. Okay. Which comes out to be, trust me on the math, 31.66666666666. Now, they're not going to list it that way at OCC. They're going to round that up to the nearest 2 digits. It's going to become the 31.67 strike. It will control 150 shares, period. When it expires, it's gone. The new listed strikes post-split will have 100 shares in them. You're done. So remember, if you trade an old share against a new share, let's say you buy an old pre-split that's 150 and you sell a new one strike, when you expire, you're going to have an extra amount of shares there.
Mm-hmm.
Right? One's 150, one's 100. So you got to keep track of that. Okay. You got to pay attention to that. Any comments, questions? I think we got a question from Doug.
Oh, go ahead. Let's see what Doug has to say.
Let's see what Doug has to say. Go ahead. Go ahead. You can read it.
That's what I was about to say. So a lot of times the brokers don't let you open new positions on those odd strikes. And that's what I was about to, that's why I asked it before.
Yeah.
A lot of times you're allowed to close your position, but not open it.
Yeah, that's a great point, Doug. Thanks for that. I think that's probably accurate. I'm trying to think of Tradier. I think he's right about that with us too. In the pro world, that didn't matter. So I was sort of rambling on from the pro world, but yeah, from retail brokerages, you're absolutely right. They probably won't let you open those. However, you can close them.
Yeah. Well, obviously, you gotta be allowed to get
close those babies. Right? All right, so far so good. Now here's where it gets tricky. We're coming up to the tricky part. Ready?
Oh no, I was going to ask another question.
Go. Yep.
Is there an ARB here?
I don't need. Yeah,
a rounding ARB.
Yes. So let's hold that on the back burner, and I want your opinion here.
By the way, this
yeah.
is like a side note. When your contract symbol, I guess it's for just the contract symbol XYZ1, but nowadays they reserve those numbers for flex options.
Oh yeah. So what do they do with?
No, never mind. I'm sorry. They put those numbers in the beginning of the symbol. So like if you're doing a flex option for SPX, it's like 1 SPX, 2 SPX, whatever.
Oh, I got you. Okay, that makes sense. Okay, next slide. Here we go. All right. Why this matters? Who the hell cares? When strikes don't break cleanly, and all I mean by that is they're not 0.00 or 0.50 for that matter, but there's some weird decimal. Adjusted options remain non-standard until expiration. We said that already. Liquidity may thin out in those adjusted series. And to Doug's point, the reason is that people aren't opening these anymore. They're just closing them. So you will definitely see a drop off in volume in those old, adjusted strikes for sure. Not going to be much open interest, a new open interest in there. It'll probably wane and things will close. The new trading in the after the split and the fresh standard strikes is based on the new stock price with standard deliverables. Just want to reiterate that it's going to be 100 shares, new strikes. Okay. Here's how pricing works with options. Okay. Now notice what happens here. Let's say you have a premium of $4. Okay. And we're going to make everything constant, interest rates, implied volatility. What you'll see is that new option is going to be reduced or multiplied by 2/3. And it comes out to be 2.666666, which they round to 2.67. There's an added fraction of a cent. That little penny gets added to that thing, to that price. Now, if you're long that, here's your question. Do you make that penny?
Don't you get it a little bit in cash?
I think, yeah, it's gonna show on your P&L if you're long it, right?
I think you get it back in your cash, right?
Yeah. So now let's take it to the what do I have on this? Oh, that's the last slide. So taking it to the next level, though, let's say the strike above it has a standard price that's divisible. There's no arb there. So you're long the lower strike, you're short the upper strike. So that's a call spread, let's say. So you gain a penny. And let's say you do the same on the put side, right? Where you do the other butterfly down below. You have the iron butterfly. You gain the penny on the long again, and you break even on the short. So now you've gained 2 pennies. And if you figure it out with boxes, you can have zero economic risk and make 2 pennies on the box on the strikes that you choose to gain that extra penny, the ones you're long. Right?
And if you have portfolio margin, you can do a lot of boxes.
Yeah. So if you don't understand that, throw something in the comments on that. It was a little arb that people did in these 3-for-2 splits on the floors back in the day because the geniuses figured this out and they said, wait, I think I can make an extra penny on both sides of these. If I do this spread right here, these don't adjust on my shorts, the longs do, I'm going to make 2 pennies, call and put. Boom. I'll do this thousands of times. It's economically no risk to me on a box.
Yeah.
Right. So it was genius, right? Just genius. I'm guessing in the retail world, we don't have access to that anymore. What do you think?
Well, I think also the spread, like the execution.
Yeah.
The spread is more like on the retail side, the spread is more than the arb. So you're not going to actually win.
Well, and commissions, and if there are any, that sort of thing. So yeah, for sure.
Spread, that's what I mean. Like the spread, commissions, all the costs. I mean, if you're doing PFOF, there is no commission, but that you're not going to, as a retail person, you're not going to make money on that. The dealer probably can, but
Now, I will say this, which was in my particular example with the 10-for-1 split in Netflix, I had a 1 lot on in the spread. Okay. It wasn't much. And I wake up the next day and it's 10 contracts now. Well, there's no economic difference there, but now I've got to deal with 10 contracts. That is a difference. So I can play a little bit different game. I can only trade 1 lot to close that thing. So now with 10, I know it's the same economic value, but I can mess around with scaling out of this. I can sell 2.
You can scale out
2. So now I can have different price points on 10 contracts as opposed to only 1 on 1 contract. So I thought that was kind of fun. And me being the dummy that I am, not paying attention, I didn't even know it was a split. So And it turned out okay. That was a little heavy, and I was short, so that worked. So
here's a question, Lex. If it is the same value economically, why do companies split?
They are issuing. Let's see. So every one share becomes 10. They're adding more stock, right? Is it dilutive?
Yeah. Mm-hmm.
It's dilutive, right?
Yeah, diluted by 10. Mm-hmm.
Yeah. So why would they do that? What do you think? I don't know. I have no idea. They want to reward.
Well, I mean, there's a couple of reasons. Number one, if they want to get more access, like, Netflix, when it did that split, I think was like over $1,000 or like 1,100, 1,400, something like that, right?
Yep.
And if you're a typical investor, you want to buy stock in Netflix, you know, it's either 1,400 or 140. You'd be willing to buy one stock at 140.
Sure.
So it increases a little bit the market share, I guess, the market that can buy your stock.
Yep.
I think that another thing too is I think a lot of those stock splits it doesn't just give you with your 10 lots more flexibility. It gives Netflix more flexibility to, maybe issue more shares or buybacks or something like that. They don't have to, it can help their calculus a little bit.
Yeah. No, I think that's fair. I think, it doesn't create more value, right? Because it's an even swap. I think you're right. I think it attracts more investors. That's got to be it.
Which does create value. So.
Well, that's good point too. And maybe the company believes that they're in such a good position. Super high stock price. It kind of limits who can play. They split it. Now a lot of people can play, and they still think there's going to be share appreciation, so that it's going to make its march back, somewhere near the old adjusted price or pre-adjusted price. That's a good play, right? So it definitely helps keep that stock in a very ideal trading range. So what do you think for a retail person the ideal trading range is for a stock? My guess is it's 50 to 150. I know it's a big wide market, but that seems like a honey zone to me for retail people. I don't know. What do you think?
I mean, I would say it starts at 0, but because but I think like if you're just buying a stock, I think the 100 to 150 it's where it starts to become a little, I don't want to say scary, but it takes up a lot more of their portfolio than like a $30 stock is. A lot of times if you're a typical retail person, what's the average portfolio size in Tradier? Like,
it's bigger than normal, but it's probably in the 23,000 range ish.
Yeah. So if you're 23,000, you want to buy like 10 shares of Netflix. That's a big portion of that. You know what I mean? Like even just 10 shares of if it was like 1,400, even if it's 140 or something. I don't know what Netflix is at right now, but even if it's at like 140, buying 10 shares, that's $1,000. That's 5% of your portfolio already on 10 shares.
Yeah.
And a lot of times too, I think even though nowadays volatility, goes both ways, and it hits, the price of the stock doesn't matter anymore for volatility, but it used to be, I guess, where like a $200 stock moving $1 or $2 or something like that was a big move,
Right.
And nowadays it seems to not matter. But
yeah, for sure. Yeah. And Doug said that retail traders like having more shares. They feel like owning just 2 shares isn't really worthwhile. And that's a good point.
Yeah, that's what I mean. Like, and if 5% of your portfolio is 10 shares of something, you're kind of like, who cares?
I noticed in one of my portfolios, I've got like 10 shares of Amazon or something like that. I don't even pay attention to. I should sell it, I guess. But I'm like, 10 shares, I just feel happy to have it.
It makes you feel a little bit better ordering from Amazon.
That's right.
Hey, look at that.
Which is my favorite place to order from. I practically do it.
I'm paying myself on my Prime membership.
Right. Funny. All right, cool. Well, that's all on stocks. Here's what we're going to do too. So keep this in mind. Comment when you can, go to YouTube and leave us some comments. We're going to do a version of this on takeovers, because it gets really tricky on takeovers. Okay, that becomes a lot of fun. There's Dutch ones. There's all kinds of crazy ones. 2-part deals. There's deals that have stubs left over and debentures and all kinds of nutty things.
Well, Skydance just took over Paramount, and then they got a new ticker.
Right. Yeah.
So what happened?
Yeah, and that's when boxes can trade more than their strike prices. So we'll talk about that too. All right, good. Have a good weekend, everybody. We're getting close to Thanksgiving. No live show next week for everyone. Sorry, that is Thanksgiving Day. We're going to be eating turkey and drinking good wine. At least I will be.
So should all of you.
So should all of you. Have a great week. It will be a slow week in terms of my work schedule because, I think Thanksgiving is one of my favorite holidays. It's the start of the season, man. So
yeah, it's the male Valentine's Day.
Yeah, exactly. I agree. Football
and food.
Football. We're having a little golf tournament. We'll have some fun. All right, man. Have a great Thanksgiving, Jason. If I don't talk to you, everyone else, you do the same. Happy trading for Mark, and we'll see you next time on the Traders Workshop. Yeah.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.